Welcome to Chartered Accountants Academy video lectures. My name is Tapio Kweziwa, and I'll be taking you through working capital management and short-term financing. This is video number 2. I hope you've watched the first video when we were explaining about working capital management. So now on the short-term financing, what are our learning objectives? At the end of this lecture, you must be able to explain credit discounts, explain credit policy, creditworthiness, collection policy, and cash discounts. Calculate the impact of change in credit policy on the profitability and net present value. Describe the facets of account receivables and management. Describe inventory management. Calculate economic order quantity and optimal level of safety inventory. Calculate and discuss the impact of working capital changes in valuations and synergies calculations. Outline inventory control systems, including just-in-time. Describe the reasons for holding cash and present a cash budget. Identify the types of short-term finance. Determine the cost of trade creditors in terms of foregone discounts. And lastly, explain factoring and invoice discounting. As you can see, we have a lot on our plate, so let's get down to business. Accounts receivables. What are accounts receivables? From your FINAC, I understand you say these are amounts that are payable or receivable to us within a 12-month period. And how do these amounts arise? Normally, they arise from after we make a sale, and then we have an account receivable. So for us to make a sale and for it to be an account receivable, it means we need to have a credit policy. And what does this credit policy entail? What are the costs associated with selling on credit? First and foremost, using your FINAC principles, I understand is a line item on your profit and loss. You have a cost, you have a bad debt expenditure, so that is another cost of selling on credit. And also you have the cost of financing debtors, and also when you give someone the debt, it means that you're going to have someone who's going to validate the credit net worthiness of that person, and also you're going to have someone who's going to be on the data side collection on collection office, where you'll be making phone calls and tracing all data. Thus, you have administrative costs of managing the data. In contrast, an optimal credit policy can enhance sales and maximize net profit in relation to relevant risk. Credit sales reduce finished goods inventory and create accounts receivables. So we're just saying sales are a pivotal to greater turnover and increase in profitability. The more we sell, the more we have profits. But at the same time, these sales have to relate to cash flows. If we make more sales on credit, it means our credit policy is also to have another part that is on the collection side of it. And what are the controllable factors to sales? If we want to boost our sales, number one, we'll start from if it's a manufacturing company, we'll start on the quality of our product. If it's not a manufacturing company, maybe you are selling and buying and selling in the retail industry, it means we're going to source quality products so that we can resell quality products. If we're in the service delivery line of business, we're going to offer a very good quality service so that our customers will enjoy and thus increase our revenue. And also, after we offer a good quality, what else can we control for us to boost our sales? We can either lower our prices so that everyone else can come and buy our products, or we can increase our price that with the minimum sales that we have, we can be able to achieve our profits. And also, once we have made a sale in the credit, we also need a very good credit policy. So the credit policy involves making decisions regarding the creditworthiness of a client, and also collection policy and settlement discounts. We have a very short example for you. We have these two people, Mary Smith and Mario Smith. So as you can see, Mary's loan was approved, and then Mario Smith was rejected. What could have been the factors that could have led the credit manager to decline Mario Smith and accept Mary Smith's loan? So the credit manager, in assessing the creditworthiness of a potential customer, they need to consider one, the customer's attitude. Okay, let's see. Mary Smith pays bills on time, current debts well within the income, and what is the attitude of Mario Smith? Never pays bills on time, credit debts are far too high. So you as the credit manager, will you give Mario Smith a loan? What is the credit history? Mario Smith is not paying his debts. What is the financial position? What security is offered? And the environment in which the customer is operating in. Mary is a dentist. Mario is a bouncer. Does he have a stable income? These are the factors that you'll be considering before you give or you approve credit. So you need to state the state of the general economy. For example, in Zimbabwe, things are not going so well. So if you give someone a loan, what if they fail to pay you back? So you need also to consider economic factors. Moving on to setting the collection policy. Now that we understand we need to have a credit policy and a follow-up as a collection policy. So on our collection policy, we have the procedure for collection of overdue accounts could affect our sales. How does it affect our sales? If our terms are too harsh, we may chase away customers. The collection period, losses arising from bad debts, and the percentage of customers taking discounts. For example, if our collection terms we give a 20% discount to customers that settle on time, most customers may settle early, but then this will affect our profits as we will be incurring a huge cost of discount. And analyzing the impact of a change in credit policy profitability. In changing the policy, management is really concerned about a balance between risk and return. So we have to change to a more aggressive policy. For example, increase number of days. Increasing the number of days on our debtors, will it give us a good return, and what are the risks associated with that? Then management is primarily concerned with the balance between risk and return, as I said. Then a change in policy would affect the following: the turnover, the gross profit, the amount receivable outstanding, the amount of bad debts or losses recognized, and also the cost of discount. It is also a cost-benefit exercise. For example, increasing the discount might increase cost, but the cost of discount increase too, thus low profits. For example, we're just saying if we increase our discount, people will pay early, but then people have paid early. What revenue do we have? Our revenue is amounts that we expect to be entitled to, so we exclude our discounts that would have granted. Thus, we have a low revenue. We have the cash flow, but we have a low revenue. So our collection policy and we also has to be on point. Then when we move on to analysis of a change in credit policy, how do you analyze the effects of a change in credit policy? Use this very simple formula. If a change in credit policy is equal to change in gross profit less change in cost of carrying receivables less cost of bad debts losses less cost of change in discounts. This is just a simple formula, and also you also have to know that when all the terms in this formula need to be used in a particular analysis. E.g., change in credit policy may increase the cost of discount, but have no impact on the bad debts. So if there's a zero, they just put a zero. If there's a minus, put a minus. This is just analyzing our change in credit policy. For more reference, you can go to chapter 12 in Korea. You'll get further detail on that. Let's move on to inventory management. Inventory management, as I said in the first video, this depends on the nature of industries. For a company that is in the service delivered, there is no inventory management. So inventory won't be a part of your working capital. So inventory management, we said we have our raw materials, work in progress, and finished goods. Inventory levels are influenced by sales. Therefore, need to focus sales to decide on the target inventory level. For example, we're just saying if we focused our sales to be 10,000, that we would then have to budget on our inventory. How much inventory should we keep in stock for us to meet a target sales of 10,000? Inventory levels, so we're just saying inventory levels, they depend on the nature of business. A retailer stocks finished goods and sales are seasonal, so we'll hold different levels of inventory. And also, if we are a bit distant from our supplier, we will tend to hold more stock because the lead time will be very long. So if we hold stock, what will these suffer from? The object of inventory management is to balance a set of costs. These costs are our holding costs and our ordering costs. What are our holding costs? I'm sure from your undergrad you understand this. And what are our ordering costs? Let's move on to find out. So examples of our holding costs, just a recap from your undergrad. Understand you have these are the costs that you incur for holding your inventory. So it may be your rental or warehouse costs. This is rent and security, interest on funds invested in inventory. If you bought an inventory on credit, then there's an interest charge on it. That means you're going to be charged for inventory that you won't be selling, the insurance on those inventory, and then there's a risk of obsolescence. So that's another inventory holding cost, and then shrinkage. That's another cost of holding your inventory. Then what is the cost of ordering cost? What is the cost of ordering? Well, these costs, just a recap: your transport costs, your order initiation costs, receiving and management of costs, quality control and verification costs, and also you have planning and production management costs. So management is a dilemma here. Should it hold a huge inventory so that it would incur low ordering costs? Yes, ordering costs increase by number of orders that we make, basing on your standard costing, right? I'm sure you understand that. The more you order, the more costs you incur. But if you make one big order, you incur low ordering costs. But then this will increase your inventory holding costs. But then if you increase your inventory holding costs, will put you in a better position. So management is a dilemma. It has to balance between holding inventory and managing its ordering costs. So on inventory management, just a continuation. Excessive inventory affect profitability. They have substantial carrying costs resulting in erosion of profit margin. These carrying costs are the holding costs that we discussed earlier on, our rentals, our warehouse, etc. So this will also reduce the asset turnover ratio, because management is our asset turnover. We're just saying our profit over our assets. Our assets include our inventories. Thus, it will reduce our asset turnover, and it won't be profitable. It will result in investors thinking we're not a profitable entity. Therefore, inventory policy is very important to ensure not holding too much inventory, but that adequate levels are held so as not to disrupt production levels. That is just what we are saying. So for us to achieve this, I'm sure you agree with me that an accurate information system is important. As for example, a computerized point of sale. If you look in your Pick and Pay, you'll see that as a good is scanned on the till, it will strictly deduct from the inventory. And what will happen after it does from the inventory? Let's move on to the inventory model. So for us to know the inventory the minimum level of inventory that we need to have, we need to consider what is the availability of our supply? What is the lead time? How fast or how soon can they get the inventory to us? And at what quality, and our quality checks and all for the inventory to be ready for sale. So for us to do this, we use a very simple formula that you did in your undergrad. This is the economic order quantity. So this model assumes that two types of costs exist: our holding costs and our ordering costs, as we discussed them earlier on. If carrying costs are added to ordering costs, the sum will be total ordering holding costs. You understand that? The intersection point is the minimal. Okay, that is fine. Then the main assumptions of economic order quantity are the sales can be forecasted perfectly. We are saying sales can be forecasted perfectly in a perfect market, and sales are evenly distributed throughout the year because it gives you an average quantity to be held each month. So we expect that sales are going to be occurring evenly throughout the year. Orders are received with no unexpected delays. So these are the assumptions, and this will help you when you are maybe reviewing an economic order quantity, as you'll be asked to discuss the maybe qualitative factors or weaknesses of economic order quantity. So the economic order quantity formula from your undergrad, I'm sure you know this. And then, as I said earlier on, it is easy for us to implement the economic order quantity if we have an adequate IT control system that tells us, well, once our inventory level reaches a certain minimum amount, it will reflect or send a message to management that can you place an order now of this inventory as it is now at this stage. But however, the economic order quantity does not give the obsolescence of an inventory on the shelf. So let's move on to accounts payable. As we said, our working capital, we have inventories, accounts receivables, cash, and accounts payables. So how do accounts payables arise? We get our inventory today, and then we do not pay. We pay them after 90 days. Thus, we have an accounts payable. But the cash that we're supposed to pay today, we have it for 90 days. Isn't that a financing or a source of finance? Working capital management relates to the investment in current assets and the financing of current assets. What do we mean by investment in current assets? We have our cash in hand, and we go to our supplier and we buy inventory and we pay them. That means we have invested in our inventory. But then if we do not pay them and they give us a credit to pay in 90 days, that means they finance us in return. Thus, financing current assets. And we also need to understand that if we get a financing, this is a cheaper source of finance as there are no costs. If we agree on a 90-day credit term, for those 90 days, there are no costs involved in this financing. So a trade credit, as you said, it's our payable. So firms usually purchase the supplies on credit, and because they'll be buying in bulk and they want to buy and resell, so they'll buy on credit. So if sales double, then the financing from creditors will probably also double, as they will get more inventory on credit. Trade credit has no cost associated with it, or is it? There is no interest cost unless overdue. But what about the foregone discounts? Isn't this an opportunity cost? Food for thought. So I'm sure you're probably wondering where working capital fits in. You will never find a question that is asking you to calculate or discuss working capital alone, but it will come integrated with other questions. For example, you can find working capital in valuations and synergistic benefits. You can find working capital in relevant costing and decision making. You can find working capital in constraint optimization. You'll find it linked in so many topics. For example, capital budget, measures and accumulation, etc. For operating working capital is comprised of operating cash, as we said, operating cash, accounts receivables, inventories, and other current assets. Then it does not include short-term source of finance like tax payable and dividends payable, because this is not sort of an operational financing. If we do not pay our tax this year, it doesn't mean we have a financing of some sort operationally. Or even our dividends, they are not sort of operational, but they are just payable. Movements in working capital are relevant for cash flows. So we are saying, as we did our example in the first video, the movement that is irrelevant cash flow, but the working capital itself is not a relevant cash flow, but only the movement from this year to next year or vice versa. Where working capital management is more efficient as a result of potential measure, we must measure the impact on cash flows of the more efficient policy in order to value the synergy and post-allocation effect. You understand this further when we do our valuations topic. So in exam technique, I've just extracted a nature of question where working capital was examined. So I'm sure you can do this. Currently, the collection period, so this was just a note on the additional notes. Currently, the collection period for the trade receivables is 40.8 days. You need to understand how are trade receivable days calculated. So they divide it like that. And then management plans to implement tighter credit controls in future. The collection period for trade receivables is expected to decrease to 41 days in 2009 and 37 days in 2010. So you see, that is the movement that we're talking about, and it will be relevant cash flow if we're asked to discuss about cash flows. Assume all sales are on credit and a 365 year. No changes in the level of inventory are expected. Thus, we're going to maintain our level of inventory. The ratio of trade payables to production expenses at present will remain the same for the next foreseeable for the next 2 years. Thus, we need to calculate our production expenses and get our ratio. If there's a movement, the movement will be a relevant cash flow. So in this case, the required it asks us to provide forecast income statements, dividends, and retentions for the 2 years ending 31 December 2009 and 2010 respectively. Provide a cash flow forecast on the years 2009 and 2010. So you see, this is where working capital will be fitted in. It won't come on its own, but it will be fitted in another question. If you want to do this question, it's in your question bank, the CAA Math question bank. It's question 10 called Discam Limited. So ladies and gentlemen, thank you so much for your time. I hope you learned and enjoyed a lot from the video. For any feedback, comments, subtractions, additions, please feel free to hit our inbox on the email above. Thank you.